Okay, so ladies and gentlemen, we are reading this question. It's on WhatsApp. We are told the current capital structure of a Hardy Limited, Yes, of a Hardy Limited is given as follows. So we have ordinary shares, we have 10% debentures, we have 12% preference shares. Additional information, number one, the current market value of ordinary shares and preference shares are given there. Number two, the debentures are irredeemable and have a market value of shillings 120 per 100 nominal value. 3, the most recent earnings per share of the company is 6. 4, we are told the company currently adopts a 60% dividend payout ratio as its dividend policy. However, the firm's future dividends are expected to grow at a rate of 7% each year for the foreseeable future. 5, corporate tax rate is 30%. Then they want us to give them WACC using the market value weights for 10 marks. How many of us think they can get those 10 marks in total? Is anybody who thinks if they got this kind of a question, they'll be able to get the 10 marks? I suppose yes. So long as you don't create a very big mountain out of just an anthill. It is one step at a time. It is one step at a time. So what I would want us to do in a very slow motion manner, let's try to get these WACCs. Of course, we know it's about weight of equity, cost of equity. So the weights. So I would want us to take 1 minute and compute the weights, all of us. We meet here after we compute weights. We start with the weights. Please remember that we can never use the book values to calculate weights. For those securities, we normally use market values. To calculate weights, we normally use market values. So then what I need to do is to come and draw this kind of a thing. What we need to do is to come and draw this kind of a thing. What we need to do is to come and draw this kind of a thing. So what we shall do, I'm going to put here the securities. So we have ordinary shares. We have ordinary shares. We're going to be a par value is shillings 10. Not dollars, but shillings, thousands, 30,000. Then we have 10% debentures, 10% debentures. 10% debentures, umetupatia par value of shillings 100 in note number 2. Umetupatia note number 2, the debentures are irredeemable and have a market value of shillings 120 per shillings 100 nominal value. Nominal value is the same as par value. So I'll have to put the par value there. And then I can see this is 15,000. Then I can see 12% preference. 12% preference, par value is shillings 20 each. Then I can see 5,000. So I'll have to create a table for number of securities. To get the number of securities, you take the amounts given, the capital given, you divide them by the par. So like how many shares do we have here? It will be 30,000 divided by 10, which gives me 3,000. 3,000. This one will be 15,000 divided by 100. Number of securities, which gives me 150. This one will be 5,000 divided by 20. 5,000 divided by 20. That gives me what here? Somebody, please give me this answer. I don't want to think too much in the morning. It's not very good to think a lot in the morning. 0.25. Where did you get 0.25 from? 5,000 divided by 20. 5,000 divided by 20, 250. Thank you very much. Now, once you get this number of securities, now you can convert them to market values now. So now we have the market value. So if we have 3,000 shares, na tunajua share moja ni pesa ngapi in the market at the moment. So at the moment, nimesha shiga na. At the moment, wamesema The current market value of ordinary share is 50. So 3,000 times 50. So could you kindly give me the market value of the shares? Market value of the shares, market value of the shares, market value of the shares. So 3,000 times 50. So 150,000 according to Monica, 150,000 like that. How about these debentures? Have they given us a market value of the, and at times they don't give you market value of the debenture. So they don't give you market value of the debenture, you simply use the par value. You assume that they are trading at par, but here they gave us really, in note number 2, they told us the debentures are redeemable and have a market value of 120 for the debenture. So times 120. Then this gives me what value, ladies and gentlemen? This gives me what value, ladies and gentlemen? So according to Gordon Warre, it is 18,000. Thank you so much. Then you got the preference shares are also trading in the stock market, in the securities market. And these preference shares, they've told us that they are trading up there for 30. They're trading for 30 bob, So then this will give us what figure, somebody here? They're trading for 30 bob. So this will give us what figure, somebody there? So this will give us 7,500. Then now I should be able to come and get the total here. So this plus this plus this, the particular answer. The three of them, when you add them, you should be able to get, 175,500. 175,500. So from there, sababu sina space pale, kuja jameni hapa mnipatie weights. Sina space sana pale. Kuja sasa mnipatie weights. So weight nitakuwa nachukua abracadabra kama ni ya ordinary share ya equity, tunasema this divided by 175,500. 175,500 divided by 175,500 like that. So then you give me the answer, you give me the answers. You can give them to me in 2 decimal places. I would have wanted to continue with that table, but now I'm missing some space there. So weight inakuja namna gani? Grace tells me it is 0.85. Thank you very much. So equity is 0.85. How about the second one, which is the debentures? 0.1, 0.10. Sasa kuna ya mwisho. Sasa 0.04 with Makoa. 0.04. So when I'd given you some time to do this question, is there anybody who got these weights correctly? Be very honest with me. Is there anybody who got them correctly? Kame says yes. Monica, yes. Thank you very much for being honest. I had no idea. What do you mean? But now the good thing is, now you have an idea moving forward. Now you know how to get the market weights. And if you look at even the videos, because I normally watch them, the videos that you did with David, he showed you guys how to get this market value weights. But the total does not add up to 1. That must be a rounding off error. The examiner will allow that. Not unless it's another one. Or if you wish, you can do an adjustment here, you make this 5. But do you think that will really matter in your final answer? No, that is immaterial. That's immaterial, but I like your keenness. It's very good to be keen. It's very good to be keen. It's very good to be keen. So thank you very much. So then, ladies and gentlemen, so now somebody tells me to, so is this one here supposed to be 0.85 or 0.86, or you want us to make an adjustment? Let's agree. Do you want us to make an adjustment to make it 1? Do you want us to make an adjustment to make it 1? Or is this 0.86? We move on. Whether you adjust or you leave it like that, at the end of the day, we get the same answers. Now we have been able to get what here we've been able to get. We've been able to get the weights. So remember, to get WACC, we have weight of equity, blah, blah, blah. So now we want us to calculate these costs. So you need here cost of ordinary shares, which is equity, cost of debentures. Then we have got a cost of preference. So I want you guys to give me KE, you give me KD, you give me, in this case here, KP. These three things are the ones I want you guys to give me. Those three things. Of importance is the concept. A screenshot, okay. Screenshot. Thank you. Great. So I would want again to give you guys a minute. You give me those three things. I know when I tell you to do these questions, I know what I want really to get out of you. I would have done this very fast, but there is some skill I want you guys to get. So please, everybody, wherever you are, you must be attempting that question. Let not your kids in this case here distract you. You'll get other kids in this case here telling you, Mami, kuna mandazi hapa, na mandazi kwa mdomo. No, now I'm writing. Now this is very serious. Look at even my teacher. Ladies and gentlemen, this is what we are doing. This is what we are doing. So I would want us to get cost of equity. I would want us to get cost of equity slowly here. So how do we get cost of equity? To get cost of equity, we normally look at these equity holders. So these equity holders, of course, they are giving us their money. For example, somebody gives us like 1,000 shillings, and then at the end of the year, we give them back their money, assuming you are paying them back. We give them back their money plus some token over and above. So we give them, for example, 1,100. So when we are getting a rate of return, which is the cost of equity, then we shall look at the dividends that we pay them. The dividends that we pay them, all over the money that they gave us. They gave us which cash? PO, right? But now remember that these dividends will have to grow, isn't it? Will have to grow, the dividends there will have to grow, the dividends will have to grow. And don't forget that these growth rates are normally 2. If you're using this approach, then here we must come and say plus what here? Plus the overall growth rate. Goja kidogo. Remember, this formula basically comes from where? This formula comes from our PO formula. If you remember our PO formula, it is DO into 1 plus G all over Kenya minus government. So if you make Kenya the subject, abracadabra, itakuwa PO into KE minus G equals PO into 1 plus G, like that. All right. So divide both sides by PO. So this disappears. It comes here, PO. Yangu is very easy. Remove these brackets like that nicely. Take this G to the other side. Plus G, like that. So that now this G disappears. But you don't have to derive really. Our work is not to derive. What in this case here, somebody told me some time back is that whenever we are getting cost of equity Kenya, you take DO who has to grow all over PO. If there are any flotation cost, if you see a flotation cost, you must subtract flotation cost, because shares at times are floated. There will be cost of advertising for share subscriptions in the newspapers. You need to hire an underwriter. But in this question, there is nothing like flotation really. So you'll simply come and say that you add, Kenya has to grow twice. Kenya is a very good country. So the growth rates here really will be what here? 2 of them. But like that. Let's start with Kenya, like that. So in this question, ladies and gentlemen, do we have DO? Let's see DO. Umetuambia note number 4. The company currently adopts a 60% dividend payout ratio as its dividends. So then the dividend here will be 40% of EPS, earnings per share. So it will be 40%, because it's a dividend payout ratio, of EPS, which has been given in note number 3, EPS 6, like that. So then this will give me what figure, ladies and gentlemen? This will give me what figure, ladies and gentlemen? This will give me what figure, ladies and gentlemen? This will give me what figure, ladies and gentlemen? So according to Monica, this is giving us 2.4. 2.4. Thank you very much. 2.4. Thank you very much. So then come here and plug in. So this will be 2.4 into 1 plus the growth rate. If you read note number 4, the company's current policy is 60% dividend payout ratio as its dividend. However, the firm's future dividends are expected to grow at a rate of 7% each year for the foreseeable future, perpetuity. So the 7% is the growth rate, forever growth rate. All over PO, have they given me the current? Remember, this is current market price of the ordinary share. It's given note number 1. The current market value of ordinary shares is 50. No growth rate. So whatever I will get out of this, I'll come and add this growth rate here, 0.07. We have no flotation, no flotation. So hapa lazima uende pole pole sana. Ufanye kitu kando na hii. Wengi hapo na kufanya unaingiza alama fanya ikando. Sema 2.4 times 1.07 divided by 50. Nipatie answer kwanza. 2.4 times 1.07 because this is Bodiman's brackets. 2.4 times 1.07 equals divided by 50. What figure are we getting somebody here? It is 60, not 40. Thank you very much. Thank you very much. How comes I'm confusing these 40 and 60? I don't know. It's because of the other question that we did. Thank you very much. It's supposed to be 60%. Dividend payout ratio is 60%. 60%. 60%. So it should be 60% of 6. Sorry for that. So 60% of 6, what are we getting somebody here? 3.6. Sorry for that. 3.6. So then we have here 3.6 times 1.07 divided by 50. Divided by 50, divided by 50, divided by 50, divided by 50, plus 0.07, like that. So according to Tobias, only gave us 3.6. So please give me this figure. Sema 3.6 times 1.07 divided by 50 inakuja ngapi somebody? 0.07704 plus this 0.07. Sasa ongeza sigana. Ukiongeza mbili according to Kame. Ukiongeza hizo mbili according to Kame inakuja 14.7 around there. According to Kame, whatever you get, you multiply by 100. You multiply by 100 inakuja 14.7%. 14.7%. 14.7%. So are we together there? Can I continue with the next one? Thank you. So this is 14.7. Thank you very much. So then you go to the next one, which is the debentures. Go to the next one, which is the debentures, and I hope I'm all right. If I rub this, yes. So then we go to debentures. So for debentures, these debenture holders, they are interesting people, very nice people. They give us money, we give them back interest. So in getting the cost of a debenture, KD, I'll always take the interest. And this interest is tax allowed. So interest into 1 minus tax all over, you talk of market value of the debentures, market value of the debentures. This normally is an easy one, times 100. Remember this market value of a bond. If there are any flotation costs, you subtract it because you're reducing the income that the company is going to get. So then remember, the bond that we have here is 10% debenture. So start by giving me the interest amount. So interest, it will be the coupon rate times the par value, times the par value, coupon rate times the par value, which is 100. So 10% times 100. Yeah, use the nominal. Don't use this amount, no. Use the par value, the nominal value. So 10% of 100. This gives me 10. Thank you very much. The tax rate has been given as 30%. So 1 minus 30% is 0.7. 1 minus 30% is 0.7. All right. So then the KD here will be the interest, which is 10 times 1 minus tax. This is 0.7. All over the market value of the bond. The market value of the bond. The market value of the bond you guys had given me, you know, it's 1. Don't take all of it. The market value of the bond you guys told me it was 120. Market value of the bond was 120. One bond. We talk of one bond. When you're doing valuation, we talk of one bond here, one bond. All over one bond. No flotation cost. The bond has been given. The bond is the same as debentures. They have told us in note number 2, the debentures are irredeemable and have a market value of 120. So then this, according to Monica and Nene, this is 5.83, 5.83%. So KD is 5.83%. Great. So then we go to the last one, not unless there is a question. Not unless there is a question, not unless there is a question. We go to the last one, which is normally the easiest. Whatever you get, remember here, you multiply with 100 to convert it to percent. To convert it to percent. So now we go to the preference. Now we go to the preference. We go to the preference. So we go to cost of the preference, and really this is the easiest. So cost of the preference, we shall take preference dividend, because that's the return we're giving them. Preference dividends all over market value of who? Of preference. Remember, any dividend can never be allowed in matters of taxation. So don't tell me into 1 minus t. No, it's very easy. Times 100. If we had any flotation cost, we would have subtracted the flotation cost. Would have subtracted the flotation cost there. Would have subtracted the flotation cost. So unakuja hapo unaandika kwanza preference dividend T. So preference dividend, the coupon rate is 12%. 12% of what value? Because I want this to be in Kenya shillings. 12% of the per value. 12% of 20. Thank you very much. Mwanza must be a very good student. 12% of 20, so 0.12 times 20. This gives us 0.12 times 20. This gives us 0.12 times 20. 0.12 times 20. 0.12 times 20. 0.12 times 20. According to FAU, Karen Gordon, 2.4. Thank you very much. Abracadabra, unakuja unasema therefore, hata kama understand kitu, you scare the examiner by these kind of things. Unasema therefore, you scare. So KP equals preference dividend is 2.4 all over market value of a preference share. Are you able to see the market value of a preference share? Are you able to see market value of a preference share? 30. It's given in note number. It's given in note number. It's given in note number. It's given in note number 1, where they spoke of preference shares currently trading at 30. Thank you very much. Thank you. Whatever you get times 100, whatever you get times 100, 2.4 divided by 30 times 100. So inakuja hapa 8%. Inakuja hapa 8%. Like that. Sasa ushamaliza kila kitu, unamwandikia formula, unadunga formula. This formula can give you a mark. It's weight of equity, cost of equity, plus weight of preference, cost of preference, plus weight of debt, plus weight of debt, cost of debt. But remember, this cost of debt must always be adjusted for what? Here for tax. So the nilivuta yangu mulisema hapa ni 8%, mulisema hapa ni 8%, right? 8%, yes. Thank you very much. So then what you need to do is to come and create a column here. Instead of writing again this, what you do, you come and create a column here. Unasema W times C. W times the cost of those securities. Unaanza na ya kwanza. Gap is somebody 0.85 times. So take the weight times the cost. 0.85 times 14.7. Then that will give us what figure? That will give us what figure? That will give us what figure? W times the cost. W times the cost. So according to Grace C, it is 12.5. 12.5%. Then we have this one here, 0.1 times 5.83%. I have 0.583. So we have 0.583%. Then the last one is 0.04 times 8%. You can ignore the percentages you multiply, but you put them at the end. So nasema to 0.04 times 8. It's easy that way. It's easy that way. So nasema Gracie 0.32%. Alafu unakuja na add zote, unasema wakaka equals who? Weighted average cost of capital. Wakaka. Please, 1 minute. Remember that this KD, you cannot subtract tax out of it, because when you are computing, you adjusted for tax, you multiplied this, the whatever figure that was there to get this 8%, you multiplied it with 1 minus what here? 1 minus tax. You did the tax adjustment. I wish I had not rubbed my figures here. You did the tax adjustment. If you try again doing the tax adjustment here, you'll be double counting. You'll be double counting. You'll be double counting. You'll be double counting. Irene, I don't know what you mean, whether you would want us again to tax there, but I suppose you and I are on the same page. So, kinene. So here, so we have 13.4. So 13.4%. And that is the end of this particular session. So this question, I'm going to put it on my YouTube channel, this one. On my YouTube channel, So please ensure that YouTube channel becomes really a big thing. Joshua Aura becomes a big thing by subscribing, you are sharing with some of your friends, etc. Great. So Kame is asking a direct question. I don't know why Kame is making this a direct question. You know, at times we have very good students who would want not to embarrass Mwalimu. No, we used to fear embarrassment when we used to be very young in the profession. Those days I remember when I used to teach like 200 students, physical classes. Those days physical classes had very many students. Like when I was also teaching at Daystar University, those days there were so many students in those universities. I don't know where they were getting those students from, but even now I think they still have many. So I could see a student putting up their hand like this to ask a question, and then automatically, Monica, you'll forgive me, siwezi kusema vizuri sana Kizungu, unasikia kujikuna. Unaogopa sana. But you see now that ends with age. Because you see now with age, I came to discover, even if I don't know whatever these students are asking, they can't swallow me. What is the worst they can do for me? What is the worst they can do for me? What is the worst they can do for me? So he has asked a very good question there. What if in this case here, you are told that this case, the price, for example, is CAMDIV. If you're told the price is CAMDIV, it has got dividends in it. If the price is CAMDIV, normally what happens in this PO, you must always subtract the dividend. Because we always prefer XDIV. Then I'll be able to do one question that came in your past paper where the price was CAMDIV, Great. Irene Juki, will we write that we are in RCM? I'm going to say self-study. That is, you know, there are those students who believe that if they write self-study, then automatically the examiner will be lenient. So I would want to leave that one to you, really. If you want to say you are at RCM, well and good. RCM Online College, well and good. And it would want to say in this case here that you are studying by yourself so that the examiner can turn his good eye towards your work, even if it's not very good, then again, you are at liberty to do that. But at the end of the day, once you pass, then you'll be able to be a very good ambassador of RCM outside there. Now you can tell people outside there I was at RCM, but the examiner, I told the examiner, no. Great. Great. So thank you so much. It has been a good day. Thank you. Be blessed. So you Kame, I will not be answering your questions because unafanya private chat Kame. Kuoneka kwa public. Ndio kila mtu benefit.